Good afternoon, everyone. Bríd O'Connell here from Guaranteed Irish. You're very welcome with us today on our webinar, which is sponsored by Davy, but also we're being joined by Davy today, so we're delighted with that. Just as a matter of interest in relation to the context and the title of the event today, Navigating a Negative Interest Rate Environment, and Davy are going to talk to us a little bit about that. Joining me today is Gary Connolly, who's Investment Director with Davy Private Clients. Gary heads up the investment advisory function within Davy and works with advisors and their private and corporate clients in designing and implementing investment and pension solutions. I'm also joined by Anne-Marie Kavanagh, who has 25 years advisory experience, where she has focused on the development of financial planning solutions and investment strategies for business owners and on the ongoing management of client portfolios. So you're very welcome in joining us today, Gary and Anne-Marie. Thanks for being with us. Just a little bit about Guaranteed Irish and why we get involved in this type of events. We've been sponsored by Davies in terms of our broadcast of webinars in the course of the last number of months since COVID-19 has come upon us. And during that time, we've managed to register with 619 different businesses out of our bank of businesses out there who are supporting jobs in our communities. And out of that, 473 businesses have actively engaged. So the webinars are a great way in which to get to businesses and where businesses themselves can network with other like-minded people and people out there battling, I suppose, to hold on to their businesses and grow them during this very difficult time. So in terms of supporting, we can't be grateful enough to Davies, who have got behind Irish businesses and their leaders and indeed owners and investors in that space. So I'd like to thank them separately for that. On a different note, just in relation to Guaranteed Irish and the businesses we represent, all delighted to be part of a large network of businesses who support each other. They try to buy from each other. They try to do business with each other. They introduce a network with each other along the way. So giving lots of opportunities to each other as they progress their opportunities and provide new opportunities for smaller clients. Also, you'll find lots of our members, the bigger members in Guaranteed Irish family, tend to help the smaller guys and give them a leg up, which is a great introduction for startups and for companies who are really young and need some experience. And the Guaranteed Irish network has been really good for that. On the back of all of that, Guaranteed Irish has really invested heavily in terms of marketing and PR to promote the concept of supporting local. And while we're all looking global to do new business and win new clients, the reality is it's really important that we fly the flag for Ireland and all businesses based in Ireland, not just Indigenous, but also multinationals who've actually chosen to invest here. So the day of state aid rules and only supporting pure Irish businesses who make products here in Ireland is over. We're very much a service economy, and we're about supporting all businesses based in Ireland who satisfy the criteria of creating sustainable jobs, contributing to our communities here at home, and keeping those communities alive through enterprise. At the end of the day, if Guaranteed Irish and if Ireland has a good, strong reputation here, more people will want to invest in either startups that are indigenously grown here, or multinationals will consider coming to invest here. Right now, we're faced with a very challenging time. We have COVID-19 on a global level. We've Brexit here in Ireland, and we're trying to negotiate our way through the European, I suppose, negotiations there with our nearest neighbours, and it hasn't been easy for our members or our clients or any business based in Ireland. So a lot of challenges ahead, and we're really looking forward to maybe doing a little bit more of a deeper investigation with my guest speakers here. And I suppose, Anne-Marie, if I can come to you first, on the front line with clients, there's another issue that's going to really push us back further now with the whole negative interest rate really hitting home, and especially in the domestic front as well as the business front. Trying to navigate it is quite a challenge for our members and businesses in general out there. What framework do you have in place to guide them through Davies?
Bríd, what I would say is that no one size fits all in these scenarios. And the approach that we would take is to first get a very thorough understanding of our client's situation. And then, rather than lead with the question how to navigate negative interest rates, we would simply ask for clients to take a step back, look at their current situation, and ask themselves, what are they trying to achieve from their wealth and their cash? And when you look at it, most of us have multiple financial goals, be it in the short, medium, and long term. And we as advisors, when we meet a client, we will get as much information from them as possible, and then we will go away with that information and prepare a financial plan. And what that financial plan will do is outline a set of recommendations as to how that individual should allocate their capital to each of their financial goals. Now, we call that approach a wealth allocation framework. So, for example, for short-term requirements, we would say that cash or other liquid options that might avoid negative interest rates can certainly be the answer. And what I would say is that most of us need cash to some extent, be it a personal individual like myself who requires cash for day-to-day living expenses, to a company who requires capital for working capital or perhaps business expansion or acquisitions, to maybe an institution who must meet their operational and capital expenditure needs in the short term. Now, in the longer term, what I would say is people have to remember that they have time on their side. And the important thing to remember then is that they can afford to take more risk because they're investing longer term. Now, the one thing to remember when considering long-term returns is that it's about time in the market rather than timing in the market. And what we have found is that the people who have a financial plan in place, they have much greater peace of mind when markets are volatile, or say when times are uncertain like now. And the reason being is that they've allocated sufficient capital for their short to medium term needs, and their remaining capital is not required for 5, 10, 15 years. So they don't have to worry about short-term volatility in the marketplace.
So, Anne-Marie, if I can just on the back of that come to you, Gary, then, and maybe you'll take us through a couple of ideas and I suppose a framework or an outline in terms of navigating the interest rate, the negative interest rate out there that you're suggesting through Davy. You might take us through that.
Sure, thanks, Breed. Good afternoon, everybody. Hopefully you can see the slides there. I promise no death by PowerPoint. I've just got a few charts that visually make a point with much greater clarity than I can verbally. I suppose the big stories you said at the start in financial circles, there's been lots of them to be fair, but over the last couple of months, I suppose the spectre of negative rates being applied to deposits from next month. Now, initially, it's just for corporate deposits and pension deposits, but retail deposit holders are most likely in scope at some point next year. But I was struck by the disquiet in the media about negative interest rates. Is it's understandable, but I was reminded of I saw a cartoon drawing in a newspaper last year, and it was around the time of peak concern in relation to single-use plastics. And it depicts I actually have it here. It depicts a customs officer inspecting a passenger's luggage, and admonishing him for having a plastic straw hidden in his bag of cocaine. And I was struck by the media disquiet in relation to negative interest rates. Kind of reminds me a little bit about this, in the sense that negative interest rates to me is the plastic straw. The bigger issue, or the bag of cocaine, to use the metaphor, is the vast sums of money that are sitting on deposit in banks. Now, as long as I've been in this business, it's been a huge figure. Today it stands at 118 billion, and this now was through a period of low rates. Now we have negative rates, and maybe this will be the trigger for action. And don't get me wrong, that's not to suggest that cash is some sort of investment mistake. I mean, it has a place. And we don't view it as like the classic investment view of cash is that it's something to avoid or minimize. But I think from a mental accounting perspective, it satisfies a kind of a current assets need. And in particular, in the context of the period of economic and financial distress that we've been through, cash has served a very vital purpose. So it has a place, but to the extent that the allocation to cash is beyond what's needed for short to medium term requirements, the reasons generally provided when you ask people about that, ask clients, be they corporate clients or retail clients, generally it's a variant on a constant kind of safety and peace of mind theme. And to me, this, I think, confuses certainty with security. So, like, if you think about cash, does it provide certainty? Unequivocally, it does. Like, we're absolutely certain. I mean, there's no doubt in relation to it. It provides absolute certainty. What it doesn't provide is security against what I believe to be the most relevant risks for long horizon investors, and that is inflation, and the opportunity cost of inaction through it investing in capital markets or more useful or growth oriented assets. And we've done some. We've looked at this and estimate that the combination of negative rates, together with inflation and of course inaction, from not investing, results in a value differential of circa just over 50% over a 10-year period. Now, what that means is that someone starting out with $1 million, for argument's sake, and sitting on their money over 10 years would see its value in real terms decline to 973 just through negative interest rates, while someone investing at what are fairly modest assumptions would likely increase their purchasing power close to 1.5 million. So this isn't an academic discussion about what is risk and all that. There are real world consequences to the vast sums of money that sit on deposit that are surplus in many cases to short-term requirements. Now, within that, I've mentioned inflation, here's a visual of going back over the last 20 years. That was a projection forward over the next 10 years based upon modest enough assumptions. And this is the impact of inflation over the last 20 years. So you see the $1 million in 2000, in the year 2000, today is worth just over 700,000. So as an impact of nearly 30% in terms of capital value. But a savvy observer would probably say, well, that's fine, Gary, but inflation actually in Ireland over the last 5, even 10 years has been very modest, or hasn't posed a risk at all. And that's a fair observation. It has. It's probably a bit difficult to see in that particular chart there, on the one on the bottom left. But it shows the HIC, the Harmonized Consumer Price Index, over the last 5 years is essentially flat. So inflation in Ireland over the last 5 years is essentially flat. But what that masks is strong underlying price trends. So what makes up that basket, and in fact we had the European Centre, or not the European, the Irish Central Bank came out last week and kind of warned is probably a strong word, but they kind of made mention of that the headline rate of inflation is probably understating the extent to which personal inflation rates are impacting, because the basket has not changed intra-year. And because of COVID-19, there has been an impact. But if you look over the last 5 years, I mean, if I think about the things I spend money on, like education, like housing, water, electricity, hotels, restaurants, health, all of those have been rising strongly. So this headline measure of inflation is actually masking that. So what really matters is my personal rate of inflation, which is actually running potentially much higher than the headline rate would suggest. So it is a relevant, it is a very relevant measure or risk to be thinking about in the long term. And I just finish off with an observation. There's a fairly nostalgic chart, well, certainly for me, for any other ice cream lovers out there. So this is a HB chart from 1979, and now I can be accused of cherry picking here. I'm absolutely guilty in terms of picking out this particular result, but I just wanted to leave you with something tangible as an example. So this is a chart from 1979. You probably can't see it there. I mean, there's lots of when I think about the data way, the Hiawatha, I mean, the furry feet, all gone the way of the floppy disk, so we don't see them anymore. But a long-time favorite of mine is the Loop. You probably can't see the price of it there, but it's 10p in 1979. Today it's €1. Maybe if you buy it in a 6-pack in Tesco or something, you might get it cheaper. But it's €1 today. So in euro adjusted terms, or old money terms, that's 78.7 pence. And when I think about that in terms of inflation, that's actually 4.9% compound per annum inflation over the last 40 years, which is pretty extraordinary. Now, we tend to think about money in our bank accounts in a nominal sense. So pounds and pence or euros and cents. Now, the only rational definition of money over the long term is purchasing power. And the reason I say that is that if I'm, and I'll use an example of retirement here, but this applies equally whether it's pre-retiree, whether it's a corporate or whatever. If I go out into retirement and I've been very conservative. So traditionally we think about being conservative, investing in assets like cash and bonds. So if I go out into retirement, 15 years into retirement, with my pot of money or my income, and I've been very conservative with this pot of money that I built up, and at that rate of inflation, so at the loop rate of inflation of 4.9, prices double almost just under 15 years, every 15 years. So if I go out in my retirement income 15 years into retirement, what I'll find is that I'm able to buy less than half the number of loop-the-loops I was able to buy at the start of my retirement. So this is so the only rational definition of money over the long term is purchasing power. And then if we think about money in those terms, what's high and low risk actually inverts versus what we traditionally think of. So what's low risk in the context of money being purchasing power is things which have preserved my purchasing power or enhanced it, which is things like equities and property and real assets. And the things which are high risk are those which have threatened my purchasing power, and they are cash and bonds. So high risk in this context, and equities and property low risk in this context. So it's just it's a different way of thinking about what risk is, but it does have, as I said, this isn't an academic argument. This does have real world consequences for people in terms of whether it's a retirement portfolio or whether it's a corporate in terms of cash holdings, that we just need to think about risks in slightly different terms, to keep pace with what I view to be the real risk to long horizon investors. So I'll probably leave, there's probably enough PowerPoint in that, Breed, so I'll maybe hand back to you.
So in terms then, Gary, the big question is, as we navigate our way through COVID, which nobody could have ever expected, cash was really important to a lot of businesses to keep things ticking over, and cash flow is the big concern out there. So the whole idea of cash is king seems to be still appropriate for those businesses. That kind of doesn't match with what you're saying in terms of the cash. So where do you draw the line in terms of those needs for businesses right now?
Yeah, look, it's a very valid point that, look, any corporate that came into this crisis holding lots and lots of cash will have been exceptionally thankful for it. It will meant the difference between survival and non-survival for many firms. So to go back to my point, it's absolutely, like, we're not here to say that cash is some sort of mistake and you shouldn't hold cash. Absolutely you should. But it really becomes a question of, well, how much? Now, that can only ever be established through, an engagement with an advisor like Anne-Marie in terms of a plan to establish, well, what is the appropriate level? And very often, if we meet with clients and we establish, well, actually you're holding the appropriate level of cash. But in our experience, there's a level of holding of cash which is in excess of what's actually required. I mean, for a business, you're going to need working capital, you're going to need excess reserve, you're going to need emergency reserves, you need cash for M&A activity. But beyond that, there is surplus, and it's what that figure is. And it's then trying to just figure that out. And to the extent then that there is cash that's surplus requirements, then we can have a conversation about, well, what's the appropriate home for it? Is it into a core kind of balanced portfolio? Is it into a high risk equity portfolio? Notwithstanding my comments about what is high and low risk, or is it into liquid low risk alternatives to cash, like corporate bonds or covered bonds? So that's a conversation that we've been having quite a lot of over the last couple of weeks, because of this spectre of negative rates. So this has been the trigger for people to act, and there's lots of conversation going on about that. But yeah, don't want to leave with the impression that it is some sort of mistake to hold cash. It's not. It's just to the extent that it's surplus. What are the alternatives? So
the real risk is not reviewing the risk.
Yeah, I'd fully agree with that. Yeah.
Anne-Marie, for the most part, you're out there in the front line. Ireland has been relatively muted on the inflation front. That seems to fall away when faced with rising costs in so many areas, including education, property, health and insurance, which Gary has outlined. What's the magic number there? And Gary, jump in on this as well.
Reid, what I would say is, unfortunately, there's no magic number. And what it comes back to is, if we look at how we measure inflation using the Consumer Price Index, And basically the Central Statistics Office every month measures the changes in the price level of a basket of goods and services, so your bread, your milk. But unfortunately, that does not give the full picture. And it comes back to Gary's point there about, if you look at the services that our clients are using, they're using services, say maybe like education, like healthcare, but the cost of those services have increased so much above inflation in the last number of years, okay? So the thing is, when we're preparing the financial plan, we don't just factor in inflation, we have to factor in the costs in excess of inflation. Because if we don't, the recommendations that we make, say to meet a client's medium-term goals, long-term goals, they simply won't work. And if you look at it, say if I'm saving for a child's education, and I'm thinking that, well, it's costing 10,000 now and it's going to increase by 2% every year. If I only allocate 2% to it, and I'm saving every year and thinking that, well, £100 a week will suffice and will work, I could be a long way off. So it's really important. What I would say to individuals is that they need to be reviewing stuff like that constantly on a constant basis. So like even with us, with our existing clients, we'll constantly review that to make sure we're meeting the client's requirements in the medium and long term. Because even now, if we look at a portfolio, and it comes to, Gary had mentioned it there already, that even if we recommended, say, a medium risk portfolio of where we aim for 6 to 7% for a child's education, because that portfolio is made up of 65% in risk assets and 35% in low risk assets, 35% is invested in bonds and cash, which is making little or no return. The 65% has to make the overall return of the 100%. So the problem now is that we're quoting 6 to 7% for medium risk investment, which everyone out there is. And even at the moment, we're trying to address that and pull it back to meet expectations, clients' expectations. But the problem is it's going to be virtually impossible to make that 6 to 7% in the current environment. So what it means is that when we're reviewing clients' portfolios, if they're in a medium risk portfolio and they've expected 6 to 7% and we're not getting it, it means that maybe one, they might have to take on more risk to do it, or two, they might have to limit what they're expecting, at retirement or save for the kids' education. So like I would say to you that it's not one size fits all, and it's like with the inflation, you have to look at the bigger picture and consider more factors in it.
And Anne-Marie, give some examples of what clients are facing out there and how they're coping.
Well, the one thing is I work as a director on the business owners team with Davy private clients. So I deal mainly with company directors, self-employed, number of institutions, associations. And what I'm finding at the moment is that their main concern is to keep their business afloat and to maintain profitability. And in the current economic climate, and depending on the sector they're in, like that profitability and situation, it can vary dramatically. And even the funny thing is, even within the sector, it can vary. And like the people on this call will understand that more than anything, because if you even take, say, a pharmacy on Grafton Street, where the footfall has fallen dramatically, and you take a pharmacy on the outskirts of any city or town, I know, like even myself, I'd be very conscious of COVID. So the whole time it's just to drop in, get what I want, and come out again. So the pharmacy on the outskirts of town will suit someone like myself much greater. So what it means is that the pharmacy, say on Grafton Street, is going to find it really hard at the moment, whereas the one that's on the outskirts probably could actually be doing even better than before COVID. So I really think it just depends on the individual company, the sector, as to how they're doing, and there can be huge variations. But the other type of clients that we're meeting at the moment are the ones who have cash on deposit. So it's back to Gary's conversation about how they're being charged, so they can no longer ignore it. So if you think of any of us, we would have left money on deposit. Like I can think my parents' time, they left money on deposit, they got their interest rate, and that's what they lived on. And whereas if you look at now, banks are starting to charge for their deposits. So if we look at Bank of Ireland as an example, from the 1st of October, they're going to charge 0.65% to institutions and corporations for their monies on deposit. Now, what that means is for every 100,000, the client will be charged €650. If the client had 2 million on deposit, they would be charged €13,000 per annum. So that's not even factoring in inflation. So what it means is the cost of the client not doing anything is much greater to the client, okay, than if they proactively look and see, well, what are their options out there? So what we have is now, it's no longer us approaching the client, it's nearly the client's approaching us and saying, Anne-Marie, what's out there? What can I do with this? Because like no institution can afford, or association can afford to leave, say, 10 million on deposit, knowing that they're going to be charged 0.65 for it. They have to act on it. But the one thing I would say with the clients I deal with, whether they have cash on deposit or not, the one common thread that they all have is they're trying to be as cost efficient as possible and run a really tight ship. And I think anyone in this climate, you'd be foolish not to be doing it, whether you're doing well or not. And so what we find is that by doing the financial plan, by reviewing all of their portfolio, and like you asked me earlier, Breed, before we started this telecall, about, you know, what would someone do if they had an investment, or what should they invest in? And it's really not as simple as that. What you need to do is sit down with the client, find out about them, find out their personal circumstances, find out what assets they have, what liabilities they have, what existing investments they have, what existing pensions they have, life cover, Section 72, literally everything from A to Z. And then it's only then that we get a picture of what that person has and where, if they have cash, where it should fit in. Okay, so no one size fits all. And like the one thing you don't want to be is following a product. What you want to do is follow a requirement that fits your need. Okay, so in other words, from a risk point of view, because I had said to you earlier, like, there's no point in me saying to you, well, actually, there's a really good product there and it's there medium risk and it's invested in a mix of asset classes. You might already have a lot of your money invested that way. So maybe it might be something different that you should be looking at. Maybe, and I'm not going to say property at the moment, because property is not the one in the sense of, I would say I'd hold back from property at the moment, okay, and just see how it pans out and how valuations are put on properties. But if you look at, there's equities out there, and there's certainly, like we'd even look at in Ireland, there's certain equities out there that we would actually think are really good at the moment, that are offering good dividends and that we can get good returns on. So I would say very simply, no one size fits all, and nobody should fall into that trap. I would advise people, no matter what your wealth is, go and speak to someone, pull out everything you have. And like, sometimes you might say, gosh, do you realize I'm under so much pressure with my business, trying to keep everything going? That person doesn't really have a clue. You know, they're in their office, they look. The thing is, that's the time when you really need to look at it, because that's the time when you need to make sure that, one, your costs are right, two, you're in the correct risk profile, and three, that you're getting the best out of your money. So not just your cash on deposits, but literally your overall wealth. And equally, to spot any gaps, any things you should be looking at. And sometimes, like when we meet a person day one, it's not that we can do everything for them day one. We might identify different needs, but some of those needs might have to be put off for the future, 6 months, a year. And it's only by keep coming back to them, keep reviewing their portfolio, that's how we deal with them. And then what you see is, over time, we have literally every box ticked, and then it's just to maintain what we've done for them.
Thanks, Anne-Marie, for that. Just to remind everybody out there on the call that we're taking Q&A, so feel free to submit questions, and I'll come to the panelists at the end, because I should have mentioned that at the top, but please do submit the questions and I'll put them to both Gary and Anne-Marie. Anne-Marie, I really like what you're saying there about the piece, and we see this with Guaranteed Irish businesses. They are so busy trying to keep their staff employed, trying to keep their business floating. They've been hit with the last recession. They're most likely still bad memories from that, let's be honest. And then Brexit and COVID, and Brexit is back again. COVID has never gone away, it's getting worse. So people are really working extremely hard, probably never harder, and also hugely challenged. And they're actually exhausted as well, because so many people have had no chance to let up. So I do think the need for a lot of people out there is to have somebody on their side who's kind of looking out for them, and particularly things like fees and things like that, and other opportunities. And I suppose one of the big reasons we wanted to host and get this webinar to our members was to say to them, just mind your cash, mind your investment, review it, get in there and go for a fresh review. Gary, if I can come to you, do you have a view then on guaranteed funds, which I've seen advertised in various places? Do they have a place in people's portfolios?
How do I answer that one? I have a rather cynical kind of view about the value in many of those products, Breed. I think what most of them are doing is kind of appealing to kind of base emotions like fear and sometimes greed, and like that's never, emotions are never good when you're making investment decisions. I think they do have a place if they are structured properly. But very often those products are distributed without any sense of where they fit in terms of somebody's overall financial well-being or financial portfolio, and because they're distributed as products, and they're not distributed as part of a wealth management or wealth allocation framework. I think a lot of them, what they're doing is, like, to go back to this idea of what's low and high risk. I think what many of them are doing is trading short-term certainty for your long-term security, or the other way around. Actually, they're trading your long-term security for short-term certainty. If you need short-term certainty, that should be dealt with as part of a financial plan, and having enough in a kind of liquidity bucket, such that you can invest a portion in the core and look at the more relevant measure of risk being inflation. But I think guaranteed funds are really appealing to they're trying to slay the wrong dragon, in my view, in terms of what risk is. So a little bit cynical about them.
And Gary, can I come in there, Breed? Do you mind if I come in there? I know with clients, even just yesterday came along there about capital protection, because we come across that the whole time. And the ideal is, obviously it's lovely to have your capital protected, but the problem is, if you protect your capital at the moment, a lot of it is you're looking at 5 years. And even if we can go out into the market and price up a product for you, but even with figures, and this was up to yesterday, we did it, what you were looking at, the return on it, say over a 3-year term, was 0.3% per annum for it being locked away totally, that you could not get it. And what we felt was that when we come to the likes of our cautious fund, where you have full access to the fund, in any 3-year period, it has never lost money. But equally, and I know you can't say past performance is a sign of future, but equally it has the potential to make much more. And the second thing is it gives liquidity. So I think when clients look for capital protection, what they don't realize is you're taking the security of having access taken away from them. And in the current climate, I really think that's a bad thing. And the other thing what Gary said, and he's 100% on it, it plays to people's thinking of, oh, I'm 100% capital protected. There is no point putting money away for 5 years and coming out at the end of the 5 years, having never had access to it during the 5 years, and making no return. And that's what's happening now. And equally what we're seeing is that products that had a conditional capital protection on them, and what that means is that it might be 60% capital protected once the markets didn't fall by 30%, or 70% capital protected. Some of those, like I had one yesterday, and if it was to mature today, it would be down 31%. So it would mean that the client would lose 1 for 1 of their capital. So even though it had a 70% protection barrier, it would be down 31%. So, and I know that client said to me, Anne-Marie, I actually thought that fund was much safer and had capital protection. So the problem is you need to be very careful what you're buying into. And like I can personally say that I haven't actually sold a capital protected product for the last 10 years. And the reason being is because I don't think it's good value for a client. So there's no point. It's better from our point of view because we have the money for 5 years. But if you said from a client best advice, it's not good advice, I don't, in my opinion, to do that.
Okay, so there's definitely an element of fear out there. So the big message is to go and deal with it rather than continue to, I suppose, stockpile away and find out in 5 years' time or however many years' time you're down. We have a question in here for the panel, if I can. Thank you for a highly lucid presentation, which is a compliment to you guys. So assuming you've made the proportionate investments, is there any good place to put your cash these days? A very hard and broad question. Anne-Marie or Gary?
I would say you need to sit down with somebody. So in other words, it's not back to a product. Again, it's to go through your own consultation. So like a financial plan should be specific to an individual's needs. It shouldn't be generic. So what I would say is that person needs to meet with somebody, sit down with them, go through what they have and what they haven't, and then it's up to us to come up with a recommendation for that cash. So rather than a product to meet the cash, because if you do that, you'll actually be doing the wrong thing. No matter how good you think the product is, you're better look at the overall situation and then make a recommendation. But there are definitely options out there rather than cash. Yeah.
Yeah, I just add to that. Yeah, I mean, there's in short, the answer is yes. I mean, there's lots of options. Once you step away from cash, you are introducing some form of risk, whether it's interest rate or duration risk or credit risk. So there is no real for like alternative, but it's modest, and it can be, depending upon the individual requirements. It can be very modest risk. There's covered bonds. A little bit more risk is corporate bonds. Then you have high yield corporate bonds again. So there's a whole spectrum. So in short, the answer is yes, but it just depends on what is the capacity for risk within it.
And what I noticed with a lot of the guaranteed Irish business owners in particular is their very big need for liquidity in such a volatile market. And Anne-Marie, you mentioned that in relation to, locking away your money and you have no access to it. What good is it to you, even if you've saved it? If your business is gone in that interim, you're in trouble. So I suppose for our members to note that. And another question I have here is in relation to percentage in terms of investments. What is the percentage between holding some element of it in cash and others in not cash, if you like? So is there a magic ratio there, 30%, 70%, or that seems to be a couple of questions coming through there?
That depends on what risk you're going to take. So in other words, if it was higher risk, you're going 100% higher risk assets, which would be the likes of your property, your shares, your alternates. If you're going medium risk, then it's your 65% in high risk assets. And what we say is that's our strategy. So our strategy is our long-term opinion, okay, on say a moderate growth. So our long-term strategy on that, or medium to long-term strategy, is that we would have 65% in high risk assets and 35% in low risk, which are your bonds and your cash. But saying that, tactically, we would change that every so often. So go back to March when markets fell. So that would be the time a lot of us would think, oh my God, get out of markets, I'm afraid. That's actually the time that we increased our equity portion on the medium risk portfolio. So we would normally have 50% in equities, and we brought it up to 55% over a period of time. Now, then what we did is, as soon as we felt, well, we're going to take our profit. And it's not that we weren't confident in equities. We just felt, well, this is a medium risk fund. This is what the client bought into. So now we'll start selling it off and bring it back down to 50%. And I would say that was another thing back in 2007. If you're dealing with the likes of Davy's, who's a private bank, okay, so basically they'll rebalance the portfolios the whole time. And that means that they'll always keep the client in medium risk if that's what they've bought into day one, in high risk if that's what they've bought into, or in low risk. And that's really, really important, because what you see with fund managers out there is that, and especially in the Irish market, they don't rebalance the funds consistently. So in other words, you could have your pension and say if it's 50,000, and do you remember back in 2007, people were saying half my pension was wiped out. That couldn't have been if they were in a moderate risk portfolio. Okay. But what happened is they bought in maybe to medium risk, but then when the equity content went up in value, they went increase the risk announced to themselves, and it wasn't reviewed. And it meant that those portfolios might have been exposed to 70, 80% in equity, so they got hit much harder. So the one thing I would say to you is, it's really important if you go into a fund that you know it's going to be rebalanced consistently, regardless of whether you meet the advisor or not.
I have another question here for you guys. What's your view on investing in UK stocks and the risk to sterling?
Well, I think UK equities have a place in a diversified portfolio. I don't know that, if you look at the UK in terms of its size, in terms of world stock market capitalization, it's about 8 or 9%, roughly speaking. So if you were globally diversified, you're going to have roughly that amount in UK equities. Obviously, the sterling risk that comes with that, and the additional kind of Brexit risk, and sterling has been quite weak, albeit in the last in the last week, but has been quite weak. And it's not just as simple as, well, you know, if you're buying, you know, I mean, if you're buying Vodafone, you're not, or, you know, that's arguably not a UK company. So the sterling risk isn't just a straight read through of by Vodafone, I've got sterling risk. Vodafone's earnings are probably the vast majority of which are earned outside of the UK. So actually, there's a natural hedge within it. So it depends really on what UK equities you're buying as to whether the currency risk is high or low. But yes, I'd say UK equities will be part of a globally diversified portfolio allocation, but it wouldn't be much more than 10%.
Okay, I am really appreciative of all of that information. In terms of, I suppose, a final roundup to our listeners then, guys. Remember, most of our listeners today are business owners and are consumed with keeping their business and the wheels on track. So they need some help. What are the nuggets of wisdom in terms of keeping an eye on why they set up in business in the first place, to help them with their own investments? Maybe to you first, Anne-Marie.
Bottom line, and I've repeated it a few times, I think review your situation, pulling yourself back. I said to you at the start, what we would advise is the client to stand back and look at the situation. And I would say to anyone on this call, the problem is if you're under pressure with your business, and like you said there, I mean, that's not just you. I smile when I hear that, because we're just constantly on the go at the moment. So everyone is in the same situation, you know, from a personal point of view and from a work point of view. So I think it's really in those times that when you're under pressure that you need to pull back and look at the important things and look at what's important to you. And the bottom line is, if you've worked really hard for your business and you know you have to fight as hard as hell for it, well, then it's time to take an hour out, look at your situation, sit down with someone. And I would say sit down with someone you trust, because the problem out there is that, like, I know I have clients, and even at the moment that I'm reviewing, and maybe they're transferring funds over to me and that, but equally there's some funds that I've actually said to them, don't transfer them. And they actually, we had initially, you know, say it might have been a month, 2 months ago before, well, it was even longer before COVID. Some of them say are property funds. And now when the valuations are coming out, I'm saying, no, don't move them, leave them exactly where they are. So it's just basically, I would say, review your situation, but with someone you trust on it, so that they'll give you the proper advice. And at least then you have a plan in place, and at least then it's easier for going forward. And you might be able to do everything now, but it'll make you aware of the stuff you can do, but equally the things that you need to address going forward. And then it's just the part about cash. I would say to anyone who has cash on deposit, you're foolish to ignore it, because everyone is trying to be cost effective at the moment, and it's not an option to ignore it. It's simply not. Between inflation and between the charge, it just, and like, it's all relative. I mean, I spoke about millions there. If I have 100,000 and that's all I have, that's as important to me as anything, you know. So it's relative. So it just needs to be reviewed. That's all.
And I'm glad you mentioned that, Anne-Marie, because I think a lot of people feel that, look, I don't have enough for someone like a Davy Group to be interested in me. But that's not the case. It's not.
No, like normally what I deal with is, I do deal with clients that a million net investable assets. But when you look at it, a lot of us have portions around the place. When we put it together, we are actually, you know, worth a good bit. And what I would say is, I'd never turn someone away. I will always help them to try and whatever. And I'll be able to, as in, if I see things that are wrong, I say, look, this is what you need to look at, this is what we need to do. And I will help them. That's just what I do. Okay. And so I would say to you, look, we have no problem. And that, like, that's why, that's our job. That's what we're here to. And, you know, like, it's a bit like Guaranteed Irish. You're trying to help people and we all pull together. And that's part of Davy's too, trying to help Guaranteed Irish. Like, that's what we should be doing now.
Thanks for that, Anne-Marie. And Gary, your nugget of wisdom, and we do have a lot of startups actually tuned in today who might not be cash rich yet, but are on the way, hopefully. And with a lot of support, we'll get there at some stage. Gary, final nugget of wisdom from yourself?
Well, like it's great. I think out of crises, come great businesses and ideas. I think it's a great time to start up a business. You find out pretty quick during difficult times whether what you're selling is worthy or not, because people just don't have the wherewithal at the time for it. Where you do have in better times. But I'd say the good thing for me is relative to the last crisis in 07, 08, corporates are went through a large or a significant amount of deleveraging in the last 12 years, to the extent where there's 50% of SMEs have no bank debt at all. Personal borrowings fell from 157 billion in 08 to currently 87 billion. So personally and in the corporate world, we've gone through a period of significant deleveraging. This is obviously pre-COVID, so we came into this crisis in a much better situation, which I think is positive. And I would say, in terms of the last thing, in terms of like it should really just saying about Anne-Marie and talking to people, there is no one size fits all solution, but the cash, for some it's going to be a lifeline, and for others there are amounts that are surplus to requirements, and it's really just using the trigger of negative rates maybe to make a decision that have been unwilling or to make, unable or unwilling to make up to now.
Well, to think that we work so hard to allow our cash go down in value would be a crazy situation. So I would urge all our own members to review that. The magic word you said there to me, Anne-Marie, ages ago was take 1 hour out. So the idea of 1 hour is fantastic, and pick up the phone and have a look at it, because I think the idea of it is much more off-putting than the actual doing of it. It's like one of those jobs you really don't want to do when you go into the office in the morning. You put it off, you put it off, you put it off. You don't want to do it, but when you do it, you feel so much more relieved, and it's a lot easier when you actually get it done. So that would be our advice and our thanks to that. I'd like to thank very much Gary Connolly from Davies and Anne-Marie Kavanagh. You've both been hugely informative, and it's only the start of many discussions. And of course, I'd like to thank Davy for being so supportive to Guaranteed Irish and all their members in helping us keep going and get the word out there. And look, we are all together better, as the strapline says. So many thanks to both of you. And hopefully we'll be talking again soon. In relation to Guaranteed Irish, we're going to be doing our next webinar targeting the west of Ireland. So very affected by tourism over there in the COVID time, and certainly during the summer, they've had a big hit, and we want to get behind them. And our whole objective is to sustain communities through enterprise. And that means keeping those jobs and businesses over there. A lot of the companies, particularly the pharma, tech, and tourism sector, hospitality sector, have been very clever at creating alternative opportunities as a result of COVID, and have become completely self-financing and competitive, and are creating alternative opportunities and experiences for us all. So please do join us on Wednesday, the 30th of September at 11 a.m. Check us out on all our social platforms, both Facebook, Twitter, Insta, and LinkedIn, and all those details will be there, and you're very welcome to join us. Again, many thanks for the sponsorship from Davies, and for us today, that's it, and look forward to talking to you next week.